team.
All right, ladies and gentlemen, welcome back to the first chart talk of the year. It is January 2nd, 2024 in the building. We're wrapping up the first day of trading here in the new year. And what a first day we got. Firstly, I want to look back really quickly at how 2023 started off. We started off at dead lows in the market. The S&P actually ticked its low last year on the first day of trading, January 3rd or whatever. I looked it up. The predictions going into last year were the most bearish they've been in a decade. And then what happens? The QQQ has a record year. Tech goes insane, plus 54% for the Qs. Semiconductors up, whatever they're up. Nvidia leads the charge. So coming into this year, and we see small caps wake up, and we see the 10-year get crushed, and we see this massive rally in equities to end the year. So coming into this year, these predictions are so oftenly based on recency bias. That's the one thing I want to convey here. It's now everyone's thinking small caps are going to have this crazy run because they did this November December ripper. And then the first day of the year today, we have our first day of action, and all the big banks, the guys who predicted the big recession last year, and said we were going to have the worst year in the market in 2023. Now they're all top picks for the year. The Magnificent Seven: Apple, Amazon, Tesla, Microsoft, Nvidia, that whole crowd. What happens the first day of trading? Apple gets a downgrade, is down 4%, and it drags down all of those names with it. And we see immediately the market does an about face, and all those names that were strong heading into the end of last year are the weakest, and the names that the more cyclical stocks was where the strength went. Healthcare, not biotechs, healthcare, but consumer staples, things like that. So we saw an about face on this first day of trading, and we'll see if it carries into the new year. Anything you want to touch on real quick before I get into a couple charts?
So you definitely touched on a few. Let me share my screen really quick. Hold on. So you touched on the 10-year. You touched on kind of the broad markets. You touched actually kind of a lot of stuff here. Again, we kind of see this Santa Claus rally at the end of the year. And typically we tend to see, the first day of the new trading year to be, a bullish day. People are very excited about the new year, new goals. But like you said, we had the 10-year gapping up today, which it came into support, prior resistance turning into support. We had the 10-year gapping up, putting some pressure on the equities today. But even if you look kind of under the hood at most of the sectors this past week, most of the major sectors and even the major markets were retesting like major resistance areas. For the Qs, they pushed through all-time highs to end of the year. But this is an area to take profits. Again, now we have a new year. So for the individuals who had big gains, especially like for the Qs, for example, if you're up 50% last year and you want to defer that tax gain till the next year, you don't want to sell it on December 31st. If you sell it January 1st, you don't have to worry about that tax issue until the end of this new year. So just looking at a lot of the charts, we're just seeing a lot of, major markets retesting these prior areas, Qs all-time highs, the IWM and mid caps, testing those major resistance areas of their bases. And just given just the run that some of these sectors have been on, we have to expect some kind of pullback, some kind of reset, which I think we both kind of highlighted in the newsletters, that we just want to be very patient and cautious into the start of the beginning of the new year, just given the runs that a lot of these sectors have been on. Like you mentioned, healthcare really woke up today along with the staples, but they just have come so far so quickly in the last 2 months that we need to expect a little bit of a consolidation or a pullback before we get the next push higher. And of course, with a lot of these big banks.
Wait, question. Why do we need a pullback? They're breaking out today.
I'm just saying in general, not healthcare. I'm just saying like in general. I'm just healthcare broke out today.
Yeah, of course.
But there's a lot of these sectors, running into major resistance. It's not surprising that some of them will start to pull back, not healthcare specifically. So that's my little take on some of the broad market stuff. I'll pass it back to you, Sheikh, if you want to go over any individual names.
Yeah, I'll just touch on the stuff I was talking about in the beginning. It's like everyone in the analyst and whatever space, their top picks this year, began with Apple. Apple down 3.5% to start the year. all these big names got pretty hurt today. We're seeing money come out of the big names, and we're seeing it recycled into other spaces. I'm really excited to, and I do agree that things need to, even though this XLV is breaking out today, I do agree that they need to chill out. But we talk about healthcare names finally getting strong. They've been sitting in this bull flag since September 21, over 2 years, 2 years and a quarter. So it's like, why can't these names finally break out and lead the market? So we haven't seen, now the biotechs, they're ripping today. And now these ones, they could definitely use a little pull in from this, vertical run they've been on. But it's very exciting to see that we're not seeing a broad-based sell-off at all. We're just seeing the names that were so piping hot sell-off. That's fine to me. Like I bought, the only thing I bought today was this DVA healthcare name coming out of a tight consolidation. But it's not like this is coming out of a major base. This went on a huge run, pulled in, consolidated, and now, I'm hoping that it makes its next leg higher. This isn't indicative of a major market pullback. This is more indicative of rotation than anything else. And, the S&P came down. We're not seeing any real fear. That's the thing. The VIX was up, but it sold off, all day. So it's like, I'm very okay with seeing tech pull in. I think tech should pull in. I think that we shouldn't have too much focus there because of the end of the year run and semiconductors and everything. But here, let's bring up the heat map. And this depicts, and we were talking about it today in the chat a little bit, like what does rotation look like? This is exactly what it looks like. We've seen countless times where this entire heat map is bloody red and it's just completely risk off in the market. We're not seeing that at all, not in the slightest. And we're seeing, telecom really tick up. I almost put Verizon on the newsletter last night. I was like, who wants to buy Verizon? And now look at it today. I love this Comcast coming into the day. I guess that didn't respond well. But Verizon, for example, it's like this is where the focus is going. And we see rates tick up. It's going to be the companies that are not as affected by the rates. What is the most affected by the rates? Long duration products, long duration securities, meaning tech, meaning growth stocks, all the small caps, things like that. Those are the ones that are most affected by rates ticking higher. So the fact we're seeing that tech completely come in as we're seeing rates tick up for the first time, but we're seeing that strength go broaden out to other sectors. I think it's a good sign more than anything else. I'm looking for some sort of a pullback in the market, maybe 3 to 5%. But I'm not looking for a broad-based sell-off where doom and destruction is going to happen, and we're going to see, market might correct. I think, if we came down in the SPY and retested this 450 area, I don't know what's going on there you go. It's 450. That's a 5% pullback right there. So, that would make sense. But I'm not ready to give up on this market yet, just seeing how much the strength went to all those sectors we talked about. And, even utilities are getting a pop. Now, normally it's not great for a very risk-on sentiment, but in the context of can the SPY continue to trend higher, I think it can, but I think it's going to be in names that weren't the leaders last year. That's the main thing. So I don't have a ton of charts to give out right now. I just, this week is really about focusing on that sector rotation and where we think this market's going to go in the next month. So, just recognizing the rotation and not getting so negative on the market yet. Definitely negative on tech and semis and things like that. But, I think there's a whole new wave of stocks to buy that haven't done that ridiculous run yet. And we're seeing money rotate in that direction. The thing is that, and then here's my last point, I'll hand it over. If the SPY is able to tick new all-time highs, every single person in the world who owns the S&P 500 is making money. That's going to take a lot of money off the sidelines. It's going to inject a ton of new life into this market. So if we are able to tick new all-time highs, I believe that could, get a lot of sideline money going and create another run for us. Or not a run like we've been dealing with the last 2 months. I don't think that's anything to expect, but I think sustained bullish action is definitely something we, is still not off the table just yet. So that's my little spiel. I got a lot of research to do and figure out, what's going to win in this market this year to start the year. Where are you keeping the focus?
So just touched on like, just to give more like a visual example, because we've been talking a lot about rebalancing. I know for a lot of people, when we mention words like rebalancing, can be very confusing when you hear it. So I'm trying to give like as simple a visual comparison of rebalancing. So we have tech up. Again, we've been talking about how tech has been the leader this past year, had a phenomenal end of the year run, but it seems like money's rotating out of tech. And in the short term, at least for today, money was rotating into consumer staples and into healthcare. So we have this line here. The chart is healthcare. I'm sorry. This chart is tech. The orange line is healthcare. So you can see how much healthcare has lagged the tech sector. This is going back many, many years, but even on, on a yearly basis, tech's up nearly, 140% since 2020, when healthcare is only up 50. So you're talking about like healthcare flagging out, looking phenomenal. Yeah, in the short term, it might look extended, but comparing tech to healthcare, it looks very undervalued in just a percentage sense. So that's where, just in that rebalance name of someone, if you own these two sectors evenly, say $1,000 in both, your, VGT is worth, $2,500. Your investment in, the healthcare sector is worth $1,500. In a simple rebalancing example, you would sell some of that tech and you would buy back the healthcare to kind of even out that portfolio. And that's what a lot of, smart money and portfolio manager are doing, especially at the beginning of the year. So like you said, this is just trying to give a visual example of some rotation. On my end, when it comes to sectors for the new year, I know you were mentioning about the S&P. Let me just get the healthcare example out of here. I do think we'll touch, again, I think retesting highs is pretty much a chip shot from here. For the end of year, like my end of year target really in the SPY isn't that much higher. Isn't this like dramatic run? I think we see like 550, 560 in the SPY. Just kind of given this recent consolidation, I think we kind of, we retest this area, we consolidate, but I think, kind of 550, 560 is my like end of year, bull case for the market. Sector wise, again, I always tend to gravitate towards the worst sectors from the year prior to be those leaders. So for example, most probably aren't aware that, the telecom sector was the worst sector of 2022, but was up there with a 45% return, where everyone thinks of tech being the winner for the year, being up 50%. Most wouldn't think that the telecom sector was in that, top 3 best performing. And that's just because it was the worst sector. So it started off in such a bad spot that if it had any little room higher, it had some room to go. And even, it's still dead smack in the middle of its overall range. So maybe, for telecom, best case scenario, you get a retest of all-time highs. But just like you said, it's still definitely research time. But my money would be on the worst performing sectors of 2023 will be more of the leaders, except for utilities. Utilities it's just not a sector that gets much love no matter what. Utilities was the worst sector this year, closed down 10%. I don't really see this being the leader this year, but those sectors that are still kind of dead smack in their overall range, names like telecom, like you mentioned, healthcare and biotech, those are probably the sectors that get probably the most love, because they're still not that close to their prior all-time highs. So other things, again, just individual names, short list is PDD, still setting up. Let me change this back to a daily. Didn't really get much of a sell-off today. Again, in the consumer staple space, we see this tight little flag here. I have a feeling that this very tight trend line will probably have to shake out first before we see a real break of this 150 or a substantial break. If it continues to hold in here, maybe we get a little break where it goes to like 154, 155. If we get some little dirty shakeout and you get that move when you don't really want to buy it back to 150, probably get a more sustained move. I think chart wise, I think this NVIDIA, even though tech has been weak, I think this is probably one of the strongest charts out there. Early in the year, we were trying to find those shorts down through 400 and just, the name just couldn't really roll over. It's had, multiple attempts at this 500. So again, it's, was super tight in the end of the year. Maybe needs to shake out this 460 first, but through that 500 through 505, I think this is probably my bigger focus from a swing trading standpoint, into the new year. So that's my last couple little points for the first chart talk of the new year.
Nice. So yeah, I think you touched on most. Research time for sure. Let's see if this strength in healthcare, bios, utilities, staples, things like that continues. And just take it 1 week at a time. big year last year. Let's try to keep the gains going. You know, and with that, we'll keep it going one day at a time.
Yeah, I mean, big shots to Higgins. You know, first day of the year, he's like already showing $40,000 in P&L. You got Tom Van Meter, first comma day, first member to have a comma day of the new year. So just good to see some new P&L for the new year.
Yeah, definitely, and especially focusing on different stocks and the ones that have been hot. So definitely, when you can recognize that, that's definitely talent in the market for sure. But all right, that's all we got for you guys this week. You got any questions for us? Let us know in the comments. Like, subscribe, all that good stuff, and we'll catch you guys next week.
All right.